A bill titled BEST Act was introduced by Iowa Representative Ashley Hinson on December 14, 2023. This bill makes an addition to the Internal Revenue Code of 1986, which is all of United States Code Title 26. This addition adds a workforce training tax credit that reduces the amount of taxes a company owes when they spend money on employee training. This credit is equal to 30% of the amount of money the company spent on qualified training for employees. These qualified training expenses are specific to entry-level employees without a degree. The type of work is important since it must be directed at skills for jobs recognized by government entities, guilds like welders and masons, or regulatory organizations like OSHA or the FAA. This credit cannot be more than the actual taxes paid by the employers for employment taxes during that fiscal quarter. If the credit does exceed the employment tax, the amount over that limit is carried over to the next quarter to be applied to the taxes paid for that quarter. The employer can also request to the Secretary of the Treasury to apply this credit to the year's taxes instead of the quarter. If the employees do not succeed at the training program, the tax applied for employment is increased during the quarter the failure took place in. This bill does not change any categories of employment. Companies will not be allowed to take other deductions or credits for that training if they take the full amount of this credit. Government and nonprofit companies are not included in this credit. This bill does allow companies to opt out of this credit if they choose to. In most cases, if a company does not provide the tax payments for employment, they would get a penalty. This bill allows that penalty to be removed by the Secretary of the Treasury if the company had a reasonable belief they would receive this tax credit. Companies will have up to 5 years after it was filed to claim the credit. The Secretary of the Treasury will develop guidance on applying this credit to parties that pay for this training outside of a company, reporting for these guidelines, and periods of reporting that failed to account the credit and expenses properly. Nothing in this bill takes away the responsibility of the companies to calculate and report their own financial documents related to this credit. The rest of this bill dictates where other laws are changed to show this bill's rules as being incorporated into existing text. Primary impact: this bill is very obviously a way for Congress to incentivize the training of employees that are just entering the workforce. They are doing this by effectively reducing the cost of training them in the form of less taxes being required of companies for any money they spend on this initiative. What this does for a business is apparent: more well-trained employees, especially at the lower pay levels, will provide the company with more productive members, making them more money. This can increase the company's ability to either expand, provide more benefits to employees, or reduce prices being charged to customers for the goods or services. On a more national scale, the United States will benefit by having a more educated workforce, even if it is technical education or vocational training. This training will have two main impacts of their own. First, the better trained professionals will perform better quality work that will help produce better quality end products and quality of life all around. Second, the entry-level requirements for many jobs could be reduced as internal training will become more effective and allow more employment. Higher employment will increase the productive capacity of the United States, bolstering the economy. Secondary impact: with all of those improvements we just talked about, there are also negative impacts that come along with them. The tax credit will reduce available tax revenue for use in government programs, though it is minimal. The increase in trained employees could result in brain drain, an economic term for the migration of skilled workers to other countries where better pay, living conditions, or incentives are available. And the increase in employment from less requirements being made for better workers will make wages drop due to the lowering of competition for a job. Employment will not rise too high, though, as these newly trained individuals will be able to perform more work than before, limiting the need for more workers. Minimum wage limits will have the opposite effect and only cause inflationary reactions when coupled with these increases in employment opportunity.